Let me know if you can spot the difference between these two couples. Hi IRS! My spouse and I made a household income of $114,000 this year working our regular day jobs. Very well, assuming you take the standard deduction, you'll owe something in the neighborhood of around $19,000 in taxes. Hey IRS, my spouse and I also had a household income of $114,000 this year from the sale of our stocks for long-term capital gains. Very smart. Assuming you take the standard deduction, you will owe $0 in taxes. Pause. We made $114,000, you made $114,000, but you don't pay taxes? Great, another rich taking advantage of our system. Not at all. I just follow John for all the daily finance tips, and in this video, we're gonna go over tax hacks that anyone can take advantage of. Hey folks, welcome back to the channel. For our new viewers, that John is me. I'm John of John's Finance Tips. We probably see it in the news all the time. A bagazillionaire here, or a mega corporation here, paying next to nothing in taxes. And automatically we think, I guess I have to be rich one day to not pay taxes. Well, the fact is, you don't have to be. Because by watching this video, I'm gonna give you my top 5 strategies to legally avoid paying as much taxes as possible. In fact, one of these strategies, specifically the last one we'll cover in the video, could potentially help you net a tax bill of $0. Quick 2 disclaimers. 1, I'm all for paying my fair share in taxes. I am from Massachusetts. We have a lot of good public services, and as a result, we have high taxes that pay for them. However, if I can avoid paying unnecessary taxes or I can optimize my tax strategy, absolutely I will, and absolutely you should as well. The second disclaimer, this is by no means tax advice at all. I'm a guy who's read a couple tax textbooks, who's talked to a CPA, who has used some of these strategies to reduce my tax bill, but I am not going to advise you on how you should act in your particular situation because there are so many factors at play. Your household income, your marital status, the number of dependables you have. And so with that being said, this video is purely for entertainment and educational purposes only. If you are to act on any of this, first consult a tax professional or your accountant. With that out of the way, let's dive into the top 5 strategies to legally avoid paying taxes. The first strategy, retirement accounts. And this applies to everybody. Just about. The most common way you'll probably see it is if you work for a standard mega corporation offering a 401k. Another way you'll see it is if you're a small business owner and you can either get your own SEP IRA or a solo 401k or set it up yourself for your employees. And the third broad category, if you don't fit into either of those first two, is you can just open your own individual retirement account. And within retirement accounts, you have 2 buckets, tax deferred and tax exempt. We'll touch on the first bucket first. These are gonna be your tax deferred bucket. Tax deferred simply means you pay taxes at a later time. So things like an employer sponsored plan, such as a 401k or an IRA, are tax deferred. Taxes are not paid in this current year, but instead they are paid upon withdrawal. And because of the fact that they're not paid in the current year, you can deduct the amount that you contribute into a tax deferred account from your taxable income. In my opinion, this is the most straightforward way for the vast majority of people to reduce their taxable income. For every single dollar that you contribute into a tax deferred account, you can reduce your taxable income by the same dollar threshold. And for the 2023 year, the amount that an employee can contribute into a 401k is $22,500. And the employer plus employee contribution into a 401k for 2023 is $66,000. And the max that you can contribute to a traditional IRA is $6,500 in 2023. The other bucket for retirement accounts are tax exempt, which does not mean you don't pay any taxes ever. It just means that on withdrawal, there are no taxes, but when you contribute, you've already paid the regular standard income tax on those contributions. So these are known as Roth 401ks or Roth IRAs. I will say not all employer sponsored plans have Roth 401ks. Another thing to note about Roth IRA contributions is if you make over $153,000 in 2023, you cannot contribute. The only way to do it is if you did a backdoor contribution in which you first contributed to a traditional IRA and then you converted it to a Roth IRA. We won't get into that in this video, but just search up backdoor Roth conversion if you make over $153,000 and you want to contribute to a Roth IRA. You're probably wondering, why do people making over $153,000 want to contribute and pay taxes today? Great question. So the difference between a traditional IRA and a Roth IRA have to do with the fact that on one side, you don't pay taxes now, you pay taxes later. On the other side, you pay taxes now and you don't pay taxes later. So the thinking is if you think when you retire, you will be at a higher tax bracket, you should ideally pay taxes today so that you don't have to pay them when you retire. On the flip side, if you're in a high tax bracket now and you think in retirement you'll be in a lower tax bracket, then you should probably defer paying taxes until you retire. That's the generally accepted rule of thumb on which you should be contributing to. I would say though, we don't know what the tax situation is like later down in life. People love Roth IRAs because of the fact that, oh, I pay taxes now, I don't pay later, this is great. But my thinking is, you pay taxes now for the guarantee of knowing what your tax bill will be when you retire. It's not so much the fact that it's gonna be no taxes, but it's more so because of the fact that our tax system and tax code is ever changing. Folks, in the 80s, there was a period in which there were just 2 tax brackets, which is crazy. Imagine if you were retirement planning during that period and you thought there were just 2 tax brackets, so who really cares? Well, you'd be in for a shock if you retired in 2023. In a pro tip, folks, when you contribute money into a traditional 401k or a Roth IRA, don't forget to invest that money, because that is just a special retirement account, but the money in there still should be invested. I've read stories of someone just putting money in, never invested it, so it just sat there for years and years and years. Make sure money is invested, and so it's gonna grow and it's gonna compound. The second strategy, using a triple tax advantage account, or specifically a health savings account. In order to be eligible to have one of these accounts, you need to have a high deductible health plan, which basically means you just have a healthcare plan, which unfortunately, but I guess kind of fortunately, I've had my entire career working in corporate America. So a high deductible healthcare plan means you have to pay a lot of money into that healthcare plan before you start getting benefit. Usually you might have to pay $2,000 or $3,000 out of pocket before insurance kicks in. But I guess as a consolation, they allow you to contribute money into a health savings account. And in a lot of health savings accounts, once you have enough money contributed in there, you can actually start investing the money. So now let me jump into what it means that a health savings account, or HSA, is triple tax advantage. Quite simply, pre-tax money goes in, money in there is invested, grows tax-free, and when the money is taken out for qualifying eligible medical expenses, it is not taxed. The contribution limit in 2022 is $3,650, meaning if you put in that amount, you just reduce your tax bill by $3,650. Then you take that $3,650, let's say you invested it in a low-cost broad-based market index fund within the HSA, that amount can compound and grow indefinitely. And let's say in 20, 30, 40 years, when you need to take that money out for healthcare expenses, because sadly, as we get older, healthcare expenses are going up, you can take the money out and you will not be taxed on those gains. That is crazy, folks. Reduce my current year tax liability. I'm not taxed with it. It grows 100% tax-free. And when I take it out for qualified medical expenses, it will not be taxed either. Okay, but what if I have medical expenses this year? That's a great question, and here's the ultimate pro tip. If you can, try to pay for all of your medical expenses out of pocket. Meaning, can you pay with cash today? Can you pay with a credit card today? Are you able to make the payment today? Because that money, remember, in an HSA, it's growing tax-free. You don't wanna mess with that compounding. And what you can do is, let's say you go to a doctor, you get a $100 bill, you pay for it cash, save the receipt, and in 10 years, 15 years, 20 years, you can file for reimbursement of that $100, but let's think about it. Instead of taking out the $100 today to pay for it, maybe that $100 compounds at an 8% average rate on an index fund for the next 10 or 15 years. And then in 10 or 15 years, you say, oh, hey, I had a medical expense from way back when. Get the $100, pay it off, but you have all of that growth that $100 was able to build for you. That right there, folks, is the golden ticket with a triple tax advantage HSA account. Oh, and one last thing. When you turn 65, your HSA just becomes a standard retirement account. And so you can take money out of there for non-medical expenses. You'll just have to pay taxes on it. Strategy 3, real estate. To be eligible, you either be a homeowner or an investor. For homeowners, there aren't as many bells and whistles, but the one I wanna call out to you is the mortgage interest deduction. So you've got a mortgage, you pay interest, you can deduct the mortgage from your taxable income. However, because of the Trump tax cuts, there are now limits to the amount that you can deduct. Namely, that the mortgage interest deduction is a tax deduction for mortgage interest on the first $750,000 of mortgage debt. Now, as we go to the other side for the real estate investors, y'all have so many more write-offs. Pretty much anything that's associated to upkeep, maintenance, additions to the property that you have as a rental property can be written off. So I'm not gonna cover everything. I'm just gonna call out the two that I think are the coolest. The first one is depreciation. This is such a cool concept. And when I first learned about it, I was just like, this is John's attempt in trying to explain to you what it is. When you purchase a rental property, you're gonna have a building and you're going to have land. In the eyes of the IRS, a residential real estate building loses useful life, meaning every single year, the IRS says that thing is worth less. this year compared to last year, compared to the year before that. And for residential real estate, I believe it's 27.5 years, where it goes, I guess, from worth something to nothing. And so when you first purchase that property and you put it into service, basically you list it for rent, you must start taking depreciation on it. So let's use an example. You bought a $700,000 property. Well, you can go onto your town's website and actually find out exactly how much the land is worth and how much your building is worth. So let's say of the $700,000 property, $200,000 is the land and $500,000 is actually how much your building is worth. Then one of the ways in which you can take a look at it, again, kind of how I understood it, so take that $500,000 of the building value divided by 27.5, and that's how much you have as a write-off every single year, which in this example is a little bit over $18,000. So every single year you get to write off $18,000. You're probably sitting there and thinking, that's dumb. My property is supposed to appreciate every single year. You're right, it does. In the traditional market, your property might be appreciating 5 or 10% every single year. But in the eyes of the IRS, that building is just losing useful life and you must take that as a write-off. How insane is that? Like the fact that in 10 years, the $700,000 property might be worth $900,000, but every single year you've gotten a write-off because the IRS is like, you gotta depreciate that building. That one really blew my mind because I'm doing literally nothing and the IRS is like, yo, take this write-off. Now, another cool thing you can do is actually break up the building. It's called a cost segregation analysis, where you come in, you hire an outside firm and they take a look at your windows or your roof or your carpet and say, you know, instead of lumping everything together into this one building and just depreciating it over 27.5 years, maybe the windows can be depreciated a little bit quicker because their useful life isn't 27.5 years, or the roof or the carpet and so on. I mean, you can get so creative with real estate write-offs, but depreciation to me is just such a magical concept. The one thing to note though is if you sell the property before the 27.5 years, there is this thing called depreciation recapture in which you need to pay back to the IRS the deduction that you took. Wouldn't be very fair, right? All this time you were gonna hold it for 27.5 years, but let's say 10 years in, you end up selling it. Well, there is depreciation recapture in which you have to take everything you've written off and pay it back. Another thing you can do when it comes to reducing your tax bill with real estate is using a Section 1031 exchange. The concept basically allows you to take one property, all the proceeds, all the profits, and roll it into another property without paying taxes on the capital gains, and you can indefinitely defer the taxes until you go 6 feet under. But at which point you can pass everything off to your kids at a stepped up cost basis and they won't pay tax on it. So an example of how Section 1031 exchange works is purchasing a $500,000 duplex, and in 10 years, you sell that duplex for $750,000. Now, you might have to pay $250,000 of capital gains. However, you remember the 1031 exchange in which you can take that entire proceed and roll it into another duplex or 3-family or 4-family tax-free, because you're deferring the taxes. And so you roll it into that property, and then later on you could roll that into another property, and so on and so forth until again, you go 6 feet under, you pass it off to your kids. The advantage is you've essentially taken this initial investment, you've deferred all the taxes on it, but you get all the benefit of the equity build and the cash flow as you either maintain at the same level of duplexes or you start trading up in properties, but all along you are deferring that tax bill until ever. And your kids, in theory, could rinse and repeat and defer that tax bill until forever, as long as you never need to actually sell everything out to get all of your money back. So take a minute to look that up. It's called the Section 1031 exchange. And a Section 1031 exchange works on the following timeline. Day 1, you sell the property. Day 45, you must identify which of your properties you're going to sell to exchange for it. And by day 180, you need to close the transaction fully, and then you do the transfer. Strategy number 4. This applies to all small business owners, people with a side hustle, and this would be your standard business deductions or write-offs associated to having a small business. I could probably go on for hours about all the different various types of expenses you could write off in a business, but I'll call it a couple that I think are cool and interesting. The plain Jane vanilla ones are things like equipment that you need for running your business. So for me, as a content creator, camera, laptop, software, those are all write-offs. For people who might be in construction, you can actually write off trucks. Now, there's a particular section of the IRS tax code, section 179, that allows you to write off a vehicle that's used for business purposes more than 50% of the times entirely in the first year. Another deduction I think is really cool is the 20% qualified business income tax deduction at a high level, because there's a lot of nitty-gritty here. It's basically saying if you have qualified business income, you can take 20% of it and deduct it from your taxable income as a write-off. Your write-off portion cannot exceed more than 20% of your total taxable income, but let's say, hypothetically, You are selling items on eBay and you make $100,000 a year. Cool. You can take 20% of that, $20,000, and deduct it from your income, which would be $80,000. Now, you can't actually write off the full $20,000 because $20,000 is greater than 20% of $80,000. So in this particular instance, you'd be able to write off $16,000 instead of the full 20. But how crazy of a concept is that? Hey, business owner, you made money this year. Why don't you take that money and just keep more of that money because you made money? Like, this isn't like an expense. This is purely, I make money. I'm gonna keep money I made. Folks, this one's awesome. This one you definitely want to talk to your CPA or financial advisor about because it gets a little hairy, but the general concept is just, it's magical. It honestly is just a little magical to me. And this third hack is leveraging an S Corp as a small business owner. Now, an S Corp is not a corporate structure so much as how you are electing to be taxed. Let me back this up. If you work a regular corporate job, you're paying Medicare taxes, unemployment taxes, as well as Social Security taxes. Your employer is also paying those on your behalf. However, if you're self-employed, you pay everything together. And I believe if you pay both the employer and the employee side, that's about 15% or so, give or take. So let's use an example. Let's say you made $160,000 in your small business selling goods and services online. Awesome, phenomenal. However, if you're just a regular LLC and you're a pass-through entity, you're gonna get hit with a self-employment tax of a little over 15% on that. Instead, if you elected to be taxed as an S Corp, you can take a look at the $160,000 and say, you know, a reasonable salary to pay myself would actually be closer to like $80,000, okay? So you take $80,000 as your salary. The other $80,000 comes in as a dividend distribution. Now, all that money is still yours, but the difference is only $80,000 is gonna be subject to the full self-employment tax. The other $80,000 is not. You just saved 15% or so on $80,000, all by making sure that you have the optimal tax entity. What I'm not saying is everyone should elect to be taxed as an S Corp and then take a $0 salary and then pay yourself all in distributions to not pay any self-employment tax. That is gonna absolutely subject you to audit risk from the IRS. You have to pay yourself a reasonable salary, but for a lot of people, yeah, $75,000, $80,000, $100,000 could be very reasonable if your revenue is $150,000, $160,000, $170,000. But again, it's all gonna depend on your particular industry and what kind of job and responsibility you have within the company. And the fifth and final tax strategy I have where you could potentially pay $0 in income taxes are long-term capital gains. So unlike ordinary income, we work a wage and we get paid and we're subject to the income tax bracket, capital gains are subject to a different type of tax bracket. And capital gains come from investing in the stock market or in real estate. In this particular instance, we're gonna focus on the stock market. So there's two types of capital gains. There's short-term capital gains in which you purchase a stock and you sell within 12 months, and that income is going to be subject to the regular income tax bracket. And then there are long-term capital gains. It's where you purchase a stock, but you don't sell it until over 12 months later. And that income has a completely different type of tax bracket. For long-term capital gains, we've got three tax brackets: 0%, 15%, and 20%. Contrast that to ordinary income from a day job, there are 7 tax brackets and the highest rate is 37%. Now I wanna really focus on the 0% tax bracket for long-term capital gains. If you are married and you file joint and your long-term capital gains is $89,250 or less in the tax year 2023, you pay 0% on it. So back to our earlier example, we have two couples. One couple makes $114,000 working a regular day job. Another couple makes $114,000, but that is from the proceeds of selling their stocks for long-term capital gains. And remember, both couples took the standard deduction in 2023, which is $27,700. So they would both now have taxable income of $86,300. Couple one, with their ordinary income after standard deduction, ends up in the 22% tax bracket. Couple two, because it's long-term capital gains, ends up in the 0% tax bracket. Guys, that's it. That's what this is all about is, okay, there's the tax strategy of what's on paper, what's clear, and then there's, can we stack and kind of piece these things together? That's where the fun is. Now folks, like I said, none of this is advice from me. This is literally things that I read about and you can clearly see I nerd out about thinking this is really cool. The fact that, okay, the tax code is complicated, but if you just read it, pull the right levers, you can do some pretty cool stuff. Now folks, I appreciate all of y'all for joining me. This has been an incredible video. As always, comments or questions down below and I will catch you all next time. Peace.